What if I told you the recent drop in silver wasn't weakness, but a deliberate liquidity flush? Not a breakdown, but a setup. Because what you're watching right now is not a normal market correction. It's a violent shakeout, hiding one of the most extreme supply crises silver has ever faced. And the trigger isn't speculation. It isn't retail traders. It isn't sentiment. It's law. A single policy change, buried in plain sight, quietly passed, and now detonating beneath the entire paper-silver system. The drop that makes no sense. Let's start with what everyone sees. Silver falls sharply. Headlines scream profit-taking. Analysts talk about cooling momentum. Charts point to technical resistance. But here's the problem. None of that explains what's happening off the screen. Because while the paper price drops, physical silver is disappearing. Vaults are draining. Premiums are widening. Delivery times are stretching. And industrial buyers are paying far above spot just to secure metal. That's not a bearish signal. That's a liquidity event. What a liquidity flush really is. A liquidity flush is designed to do one thing: force weak hands to sell, margin calls, stop losses, fear, paper contracts get dumped, leverage unwinds, price falls fast, but nothing changes fundamentally. Supply doesn't improve, demand doesn't vanish. In fact, demand usually accelerates because the buyers who actually need the metal don't care about charts. They care about availability. And availability is collapsing. The hidden law nobody is talking about. Now we get to the part the mainstream is in touching. Executive Order 14346. This order didn't target silver directly, which is exactly why it matters. Here's what it did instead. It placed heavy tariffs on finished goods, solar panels, electronics, energy components, but it quietly exempted raw silver bullion, specifically Annex 2, Commodity Code 71069011. That exemption is the spark, the incentive that breaks the system. Think about what that means. It is now cheaper to import raw silver than to import finished products that contain silver. So if you're a manufacturer, why would you import solar panels when you can import silver and make them domestically? You wouldn't. And that's exactly what's happening. This policy creates a reshoring vacuum. Factories don't move because of speeches. They move because of margins. And EO 14346 rewired those margins overnight. Silver becomes a vertical demand monster. Here's the consequence no one priced in. When manufacturing reshoring accelerates, silver demand doesn't just rise, it becomes vertical. Because now silver isn't just an input, it's the foundation. Every panel, every battery, every AI server, every EV, every defense system, all competing for the same finite metal. And the US doesn't have it. The US silver deficit is catastrophic. Let's talk numbers. The United States mines roughly 1,000 tons of silver per year, but it consumes nearly 8,000 tons. That's not a gap, that's a chasm. For decades, that deficit was filled by imports. Cheap, reliable, invisible. That era is over. China closed the door. As of January 1st, 2026, China implemented silver export controls. This is not rumor. It's strategic. China produces and refines a massive portion of the world's silver, and now it's keeping it. Why? Because silver is not jewelry, it's infrastructure, solar, EVs, defense, AI. China isn't hoarding for profit, it's hoarding for industrial survival. Resource nationalism is spreading, and China isn't alone. Mexico, Peru, other producing nations, all tightening exports, all prioritizing domestic supply, all recognizing silver as strategic. So now look at the equation. US demand exploding, global supply shrinking, and the paper price is falling? That's not a market. That's a disconnect. The two-tier market is now exposed. This is where everything breaks. There are now two silver markets, the Western paper market and the Eastern physical market. In New York, silver trades around $74. In Shanghai, silver trades near $86. That 8+ spread is not arbitrage noise. It's a crime scene because it proves the paper price is not clearing the physical market. Metal is flowing east, contracts are settling west, and the gap keeps widening. Why this spread cannot last. Markets can tolerate small inefficiencies. They cannot tolerate structural lies. As long as that spread exists, arbitrage drains physical metal from Western vaults. Every ounce shipped east makes the paper system weaker. Until one day, someone stands for delivery, and the metal isn't there. The Fed is trapped now layer in the macro reality. Tariffs raise costs. That's inflation. The Fed's job is to fight inflation. But here's the trap. If the Fed raises rates, it kills the reshoring boom the government just engineered. Factories shut, capex stalls, jobs vanish. So the Fed can't hike. That means inflation wins. And when inflation wins, hard assets reprice. The inflation feedback loop. This is where silver becomes explosive. Tariffs raise prices. Inflation rises. Investors buy silver as a hedge. At the same time, manufacturers buy silver to produce. Both sides pull on the same supply. That's not cyclical. That's reflexive. The more the price rises, the more demand accelerates. Biflation. Silver's unique trap. Most assets face one force at a time. Silver faces two. Deflation in finished goods margins. Inflation in raw material costs. That's biflation. And silver sits dead center. It's both the hedge and the bottleneck. Why paper cannot survive. The paper market relies on one assumption, that most contract holders won't demand delivery, they'll roll, they'll settle in cash, they'll trade the promise, but industrial buyers don't want cash, they want metal. And when they stand for delivery, the illusion ends. This is the shakeout. Before the break. The recent price drop wasn't the top, it was the last test. A final attempt to flush out holders, to free up liquidity, to delay the inevitable. But every ounce sold paper side moves into stronger hands physical side. And once that metal is gone, it doesn't come back because you can print contracts. But you cannot print silver. And in the next part, we're going to talk about what happens when delivery fails, when force majeure becomes real, and when the paper price is no longer allowed to exist. Now let's talk about the moment everything breaks, because markets don't fail gradually, they fail suddenly. Not with a headline, not with a warning, but with a missing ounce. The day delivery fails, the entire paper-silver system rests on one fragile belief, that delivery will never be tested at scale, that futures contracts will roll, that ETFs will settle in cash, that industrial users will source elsewhere. But that belief only works when metal exists somewhere, and right now it doesn't. Vaults are being emptied, not rotated, not replenished, removed. Once industrial buyers stand for delivery and hear the words delayed, cash settlement, or force majeure, the paper price becomes meaningless. Force majeure is not a theory. Force majeure is not a conspiracy. It's a clause. It means we cannot deliver. And when that happens, contracts don't reprice gradually, they gap. Because the market suddenly realizes the paper price was a lie. Why the convergence will be violent. People assume paper and physical will meet in the middle. They won't. Paper doesn't pull physical down. Physical drags paper up. Because when scarcity is real, price is the only rationing mechanism left. Premiums stop widening. Delays stop stretching. Instead, the screen price jumps until demand breaks. That's not speculation. That's arithmetic. Why this isn't 2011 or 1980? Every time silver spikes, critics say, we've seen this before. No, we haven't. In 1980, it was a speculative corner. No industrial shortage. In 2011, it was monetary fear. Supply still flowed. Today, it's industrial survival, geopolitical restriction, structural deficit, and zero elasticity. This time isn't emotional, it's mechanical. Why the paper sell-off was necessary. The recent drop wasn't random. It served three purposes. 1. Flush leverage. 2. Shake out late entrants. 3. Transfer metal from weak hands to strong ones, because the system cannot break until the last retail seller is exhausted. That's how markets clear before repricing. Who is buying? Right now, not influencers, not day traders, manufacturers, sovereigns, strategic buyers, entities that don't care about volatility, they care about continuity. They don't need silver cheaper, they need it available, and they're paying whatever it takes. The moment charts stop mattering. There will come a day when technical analysis goes silent. RSI won't matter. Moving averages won't matter, because price will move in gaps. And when markets gap, there is no entry, only regret. The gold-silver ratio reality. Let's talk targets, not hype. At a conservative 40.1 ratio, silver is $110. At a historical squeeze ratio of 30.1, silver is $147. And in true manias, 15.1, that's not prediction, that's precedent. Why ETFs are the wrong tool. Here's the uncomfortable truth. Most silver ETFs do not guarantee delivery, they guarantee exposure. Exposure works until it doesn't. In a physical crisis, exposure settles in cash. Cash during inflation is the asset melting fastest. The final divide. This market will split cleanly into two groups, those who hold paper and those who hold metal. One holds promises, the other holds atoms. And when the system chooses who gets paid, It won't be fair. It will be physical. The window is closing. This shakeout was the warning. The next move won't ask permission. You won't get dips. You won't get comfort. You'll get headlines explaining what already happened. The only rational action. This isn't about trading. It's about positioning. Owning what cannot be printed. Holding what cannot be diluted. Silver isn't just money. It's infrastructure. And infrastructure always wins. Final thought: markets don't reward foresight. They punish hesitation. And history doesn't remember those who waited for confirmation. It remembers those who understood the mechanism before the mechanism snapped. This is not financial advice. This is structural awareness. And the question now isn't, is silver going higher? It's, will there be silver left when everyone finally realizes why?